All right, what's up, guys? So this is the start of a new playlist. It's basically going to be titled Learning the Basics. I see a lot of you coming on here for my day trading content when you guys have little to no understanding of the markets in general, how they work. So I want to give you guys a very simple overview of what I use the stock market for, what I use the futures market for, what their purposes are, what is the differences, what are the benefits of using one versus the other, and whatever timing you use them. So that is basically what's going to cover. So starting off, the channel is going to go from explaining the basics of the stock market versus the futures market. Then I'm going to transition over to day trading. I'm going to explain the basics of day trading, how liquidity works, how the market moves, a lot of the theories that I have and what I've learned over the years. All the fluff and BS, I'm going to take it out and I'm going to put in only the things that you need to know to speed up your learning process. We're going to make it as simple as possible. Then later on in the playlist, that will all be completed and I will go into other things that I personally do to make more monthly income. Majority of that is swing trading and option selling. So I'm going to go over both of those as well in this playlist. I want to make sure that you're only spending times on the things that you want to learn about. So this playlist will be covered in chapters and you can go through the playlist and pick the types of videos that you want to learn about and skip the ones that you don't. So starting from a super basic perspective, what is the stock market? What is the futures market? Well, the stock market is obviously just general markets. It's comprised of hundreds of thousands of different companies, Tesla, Google, Microsoft, Amazon, Apple. And when you invest in the stock market, you are basically taking ownership of a portion of the company. You can invest in stocks. So you can own individual shares, right? Let's just say this is your specific share that you own, and you basically hold it for the long term. The stock market is designed to go up over time. So if you look at the stock market over the last 100 years, you can see that it goes up over time. So basically the goal of owning shares of a company is to wait for the market to pull back and you buy the dip and you just wait for it to continue higher. And every time we get pullbacks or stock market crashes, they happen approximately once every 3 years, give or take. You want to be investing at these points and riding it all the way up. But in general, the market is programmed to go up over time due to inflation, due to GDP growth, due to so many different factors. And so you want to be investing for the long term. So the futures market is a little bit different. The futures market actually, I don't know if you guys knew this, but it originated for farmers. And it was kind of like a protection that they used in relation to their crops. So if a farmer believed that a certain season of the year was going to bear more fruit or more crops than previous seasons, they essentially created this future system where they could guess whether or not crop yield would be good or bad, and they would be able to lock in prices at certain levels. It's a very interesting concept, and now it's used for all different types of commodities, for anything ranging from orange juice to NQ contracts like I personally trade on a daily basis, cattle futures, grains, gold, basically anything you can think of, there is a futures market for it. But essentially, when you purchase a futures contract, you're not actually owning a share like you would be if you purchase an ETF like the S&P 500 in the stock market, or Tesla or Google or Microsoft or Amazon. You're essentially betting on a future outcome. It's like a prediction. And a lot of the times people use leverage for futures. So for example, if you want to trade some asset or commodity in the futures market and you want to trade, let's say, $100,000 worth of that asset, there are times when you can actually go in and trade with leverage and control $100,000 worth of that asset for essentially $5,000 or 5%, a leverage position of this total asset. So it's basically betting on the future. The tax benefits are a lot better. So when I trade NQ personally, you're only taxed 40% of your profits at the short-term capital gains rate, right? Short-term capital gains is basically the highest tax rate gains you get in the stock market, and 60% of your earnings are taxed at long-term capital gains, which are a lot cheaper. It varies between 0, 15, and 20% depending on your income. So of course, let's just label this SM for stock market. This is good for long-term investing. This is good for earning dividends. This is good for owning companies, and it requires a lot more patience. Okay, so the stock market, again, this is where you own companies, you have ownership, and you hold them for the long term. You get paid dividends through individual companies, which is kind of like almost like monthly rent that you earn on a house, but instead it is through the stock market. So the companies pay you their dividend. And of course, a lot of the times you're holding this for long term. So this requires a lot of patience. You can also swing trade, which basically is kind of like day trading, but instead of trading within one specific day, you oftentimes are holding these companies for a longer period of time, between a week to sometimes even up to 3 to 6 months, but you're buying individual companies and you're trading them for longer periods of time. That is everything that I personally do in the stock market. Now, the futures market, again, I've explained it before, but this is what you use for day trading. You oftentimes are holding the position for sometimes 30 seconds, sometimes a minute, sometimes 15 or 20 minutes. But in general, this is very short term. You don't own any companies. You're essentially betting on a prediction of where price is going to go for a specific asset. And again, this can range from anything from gold to orange juice futures, some metals, and even cattle. So when I live stream on YouTube, what you're seeing is actually me day trading, and I trade a ticker symbol called NQ. NQ is short for the NASDAQ. It is the same thing as, for example, QQQ in the stock market, which you can own for the long term, but this is the futures version of it. So it is basically what I use for day trading and how I save a bunch of money in taxes. Another difference between the futures market and the stock market is the stock market is open from 9:30 a.m. to 4 o'clock p.m. Monday through Friday. The futures market is open 23 hours a day, and it's excluding Saturday, and then it opens at 3 p.m. on Sunday. So the stock market is open intraday, Monday through Friday, and the futures market is open 23 hours a day. Saturday it is closed, and Sunday it opens at 3 p.m. So it's basically open a lot longer. All right, guys, so that is the difference between the stock market and the futures market. Even though they do have differences, I will tell you guys right now, no matter what you're trading, whether it be cryptocurrencies, whether it be the futures market, whether it be the stock market, everything behaves the same way. I told you guys that the stock market is designed to go up over time. So if you're a long-term investor, you want to buy your favorite companies on discounts when the market crashes or when there are big dips. But if you're looking to day trade, this is where things become a little bit more complicated, but I'm going to, again, make it as simple as I can. You have to understand a term called liquidity. Liquidity is essentially, in its most basic form, how easily money can flow. If money flows easily and there's a lot of buyers and a lot of sellers and a lot of demand or interest for a product, it is more liquid because there are more people that are interested in buying and selling it. It's kind of like water, right? It flows. The more liquid it is, the more smooth it is, the more easily it can move from one place to the other. That is called liquidity. And the markets run the same way. If you're trading an asset like gold or oil or something that has a lot of demand and a lot of supply, it's going to move much more smoothly and more efficiently. Versus if you're trading something that has super low interest, some random rare earth metal that has very little use case in the real world, it's going to be illiquid. It's not going to move as fluidly as something like I said before, gold or oil or silver or sugar or coffee. So I only like to trade stocks that have very high levels of liquidity. In my specific case, I told you guys I trade something called NQ, which basically tracks the NASDAQ, which tracks a big group of the top companies in the United States. And so it is super liquid and it moves very easily. So when I day trade, I am looking for areas of liquidity, and I expect the markets to move at these areas of liquidity. Where does liquidity form in the markets? I explained to you what the definition is, but when you look at liquidity on a chart, there are points in the market where there is a lot of liquidity resting. And where that comes from is essentially the highs and the lows in the market. So if you imagine this kind of like a valley where there's mountain peaks and mountain troughs, the highest and the lowest points in the market are the areas where liquidity is resting. Peak, peak, valley. Peak, valley. The highest and the lowest points are where the liquidity is resting. So when I day trade, my biggest areas of focus of where I'm looking to enter trades are close to these peaks and these valleys because they oftentimes are where the market is going to make its biggest moves to the upside. For example, if you were to buy here, you'd make a huge move to the upside. If you were to sell or short the market here, you'd make a huge move to the downside. So I'm looking for these areas as points of reversal. This is where I'm going to be buying, for example, and I will try to sell close to the top. And a better way to understand this is there's always going to be a buyer and there's always going to be a seller in the markets. Now, this doesn't just relate to stock trading, it relates to just life in general, right? If you have an orange that you're looking to sell, you can't sell the orange unless somebody buys it from you, right? So if you're the seller of a product, there always needs to be a buyer. The same thing correlates to the stock market. And I don't want to confuse you guys too much, but you have to realize these markets are super complex. It's not just regular people like you and me. There are huge hedge funds with tons of money. They have these crazy computer systems that they use. And essentially these markets are designed to make regular people like you and me lose as much money as possible. So the big money and the computer systems recognize these highs and lows in the market, or essentially liquidity in the markets, and they like to drive the markets up and down below and above these highs to stop out traders who are trying to make money intraday within the market. So to make this simple to understand, imagine if you were a buyer of this specific asset right here, you were benefiting from this huge move up, but the big money and the computers know that you bought the stock down here because there is a low in the markets. It signifies the reversal spot where more buyers bought the stock and brought it higher, and their job is to stop out all of those traders by bringing the market back down below this low to make sure that you do not make any money. And the same concept here. Imagine if you were a buyer of this asset here, you rode it all the way up here. The computers and the big money know that lots of people bought the stock down here, so their objective is to drive the markets all the way back down below this low to stop you out and make sure you don't make any money. So essentially, once again, you have to realize that just like Las Vegas, just like casinos, it's always the house that wins. And the house in this case is the big money, the hedge funds, and the computer codes that they run. They want to collect all the money while you as the retail investor loses all of the money. So bringing it back to the buying and selling idea with the orange, if big money wants to buy a bunch of oranges, they need people to sell oranges. So when they bring the market down like this, everybody who was buying the oranges here is forced to sell their oranges, and this big money gets to pick up all these oranges for cheap down here, and they get to ride it all the way up to this high, and they sell their positions here. That brings the market down, in which case they get to buy even more oranges for cheap from everybody who was forced to sell them when the market came down and swept this low. So now that you know that the market is pretty much rigged, I know it's hard to believe. It's not just buying and selling pressure. There are highly complex algorithms, codes, and big money that want you to lose. Yes, that kind of sucks, but in reality, it's actually an enlightening experience because now you understand the markets are manipulated and you are able to take advantage of that by being on the right side of the trade because you know what to look for. If you have a statistical edge in the market, meaning you know that this type of thing happens and you have a good system, your odds of success are significantly higher than, for example, going to the casino, where no matter what you do, you are going to lose money over time because the odds are always against you. That is the end of lesson 1 of learning the basics of the markets. In the next playlist, I'm going to go over actual real world examples in the charts. I'm going to go over what liquidity looks like on a real stock market or futures market chart. And I'm going to go into a more complex system called the fair value gap, which is the model that I use. And I'm going to combine liquidity and these fair value gaps to show you how and when to enter a trade, how to protect yourself using risk management, and a lot more. So stick with me, guys. I know that this is going to be a lot of information. I know that can be very difficult to process and stay focused on. But if you want to have success in these markets, it is not a get rich quick scheme. So you need to be prepared to put in the work to be able to see the rewards in the future. So if you want to make money fast, I suggest you actually stop watching these videos entirely. If you are willing to put in the work and you actually want to learn, go to the next playlist and check out how liquidity and fair value gaps work.